Okay, in the following lesson, I'll be covering the order fulfillment concept, right? Which is a preliminary topic to understand, the basic concepts of liquidity. Okay, so if you're able to understand the fulfillment of a buy order and of a sell order, you'll then be able to identify where liquidity lies on a candlestick chart. Okay, so let's start by taking a look at my screen over here, where we see two buyer scenarios and two seller scenarios. Okay, let's start with the first buying scenario. Okay, so in the most simplistic form, right? If we're buying an asset, right? Let's just take an example, right? When we're neutral, right? When we have no positions open at all, our account, right, is neutral. It's at zero. Okay, if we're buying an asset, right? Let's say we're buying one contract. So in this case, we would be plus one contract. Okay, to make a profit, right, we need to sell the initial contract that we bought at a later time, right, at a higher price. Let's say this was at $2. Okay, we want to sell at a profit. This could be $3, right? Meaning that the first contract that we bought, we sold at a later date, right, at a higher price, making a profit. Whereas when you're not making a profit, right, and you incur a loss, essentially what you're doing is you're buying a contract, and unfortunately at a later date, price went down. So let's say you bought here at $2, same in this case here, right? But then you had to sell at $1, right? So instead of generating plus $1, excuse me, you incurred a loss of $1. All right. Now, for you to understand this easier, right? When you're taking an order on a currency exchange, on the currency exchange market, right? We enter at a certain price, right? Let's say we're buying, right? So this is our entry. Okay. Typically you would place your stop loss below, right? And then your take profit above. So your TP in this case would be selling, right? Here on your entry, you're buying one contract. Your take profit, right, is the opposite order. It's either you're selling the contract at a profit or you're selling at a loss. So this is your stop loss, right? There's two scenarios. Like I said over here, there's the profit scenario and there's the loss scenario. So in both cases, on a buy entry, right, your stop loss and your TP orders are the opposite of your entry, right? So if you're buying, they would be selling orders. Okay, so if price gravitates to your TP, you'd be selling at a profit, whereas if it gravitates towards your stop loss, you'd be selling at a loss and incurring a loss. Okay, so this is what explains the sell side liquidity scenario, right? So it's the contract that the buyer sells at a loss, which is met with a buyer on the other end, right? So if you're selling, okay, if you're selling at a loss, there's someone else buying that contract, right? So for someone to buy a contract, right, you need someone else selling, right? It's just how orders are being fulfilled. When you're selling at this price, someone else must buy, right? And in the currency exchange market, it's such a liquid market that these orders are filled instantly, right? Unless you're trading huge institutional level volume, then you wouldn't get filled. Your order wouldn't get fulfilled instantly, right? It would take, it would be fulfilled in chunks or in order blocks, right? And that typically you'd see it in, the equities market where the volume is much lower, especially if you're trading like penny stocks or something like that, right? So the spreads are a lot wider. And if you're buying, let's say, 1,000,000 shares, well, then your order might not get filled at that one specific price that you want it to be filled. Whereas in FX, as a retail trader, those orders are filled pretty much at the price you're looking at. Sometimes there's a little bit of slippage, but most of the time it's pretty accurate and pretty latent. Okay. Now in the other scenario, right, we have two seller scenario. So same as to in a buy case, right? When you're selling a contract, meaning you're short selling, right? You want to sell at the current price to buy it back at a later date at a cheaper price to make a profit, right? That's the basics of short selling. However, if you're buying back at a higher price, right, you'd be incurring a loss. So if you're short selling, your initial position is 0, right? You're short selling, you then you sell a contract, right? Let's say this is $3, right? You'd want to buy it back at a cheaper price to generate a profit, right? So then you'd be buying back that contract to be back at even, right? And that would be generating a profit. Whereas in a loss scenario, right, you would be selling over here, okay? And then you'd be buying back that contract more at a more expensive price, incurring a loss. Okay, so once again, for a sell order to be filled, you need someone else buying, right? And then when you're buying back that contract, you need someone else on the other end of the trade that is selling, right? Which explains the buy side liquidity, right? Which is the contract the seller buys at a loss is met with a seller on the other end. Okay, so in the foreign exchange market, if you're taking a sell order, right, this would be your entry over here. Your stop loss would be above, and then your take profit would be below, right? So your entry is -1 contract, and then your stop loss would be +1 or +1 for your take profit. So depending on where price taps, right, this is where you're going to be buying back your initial contract from your entry price, right? It's either at a loss if it hits stop loss or at a profit if it hits take profit. Now, what's on the other end of your stop loss or your take profit? It's someone else looking to sell, right? So if you sell or buy too early, there's going to be liquidity, which is your stop loss, where most of the time financial institutions will target, right? Because their orders are so big, they need to seek liquidity for the orders to be filled, and that's where all the orders lies. Okay, so let me show you an illustration that would facilitate the comprehension of this concept. Here we go. So this is just one type, one liquidity model where we have a range, right? So in a sideways market, essentially you have a level of resistance and a level of support. And above those areas, it's highly liquid. And the reason behind that is because of the concept of liquidity we just spoke about, right? So above a range, we have buy side liquidity, which is buyers buy stop orders or sellers stop loss orders. So if you have your typical retail trader selling at resistance over here, right? Let's change colors to make it easier to see, right? So you'd have a retail trader selling at resistance, right? So this would be his entry. His stop loss would be above, right, the level of resistance, and then take profit at the bottom or lower, right? Let's say it's lower here, so TP, okay? Now, if price is being undecisive and we're in a ranging market, we know that in a ranging market, essentially it's where big financial institutions, right, BFIs, are generating order flow for either an impulse to the upside or to the downside. Now that we're covering the concept of liquidity, before an impulse in either direction, there's usually a draw on liquidity. So for price to move, let's say, to the downside, right? Typically, you'll see price running liquidity above these highs, right? Tapping into the liquidity that lies above here, and then price will shoot to the downside, right? This is typical price behavior, and it's explained by buy side and sell side liquidity, right? Because in the liquidity area, you have retail traders either selling, right, at resistance, and their stop loss are above. So their stop loss, right, if they're selling over here, right, they were met with a buyer, and then to close their initial sell order at a loss, right? They need that means they're buying back their order, right? Or buying it back from someone else, right? But on the other end of this order, we have a sell order, which is us, right? We are looking to sell in those liquidity area. We don't want to trade with a retail approach. We want to take in that information and take advantage of it, right? Now, same thing with sell side liquidity. You can have, right, buyers stop loss acting as liquidity. So if you buy over here, right, your +1 contract, your stop loss will be -1 contract. And for the -1 contract to be filled, you need someone else to buy, right? So this is where we're going to buy and then get the right direction. Okay. Not only you see buyer stop loss and seller stop loss, you also see in the case of buy side liquidity, right? Retail traders trading the breakouts, right? So a typical retail trading approach is within a range. They know that there's going to be we both know that there's going to be a breakout in either direction, right? Now, if you ignore the whole concept of liquidity, which retail traders do, right? They would place stop orders above and below. So wherever price chooses to break out, right? They will get activated. Their trade will get activated, and they would be expecting price to continue up, right? To then make a profit. Same thing with the sell area, where price, as soon as it hits the stop order, price activates your order, and then they would be anticipating price to keep going lower. Now, it does happen in some cases where price does that. However, most often than not, price will seek liquidity in one direction and then come back into the range and go in the complete opposite side, right? Inducing retail traders to take a loss. Now, their stop orders, right? The buy stops above here would be buying a contract, right? Because they want to sell at a later date higher, right? What's on the opposite side of a buy order? It's a sell order, right? This is what we're going to look for to sell at. And this is what banks and financial institutions aim for, right? This liquidity up here to then go in the direction that it is meant to go. And most often than not, the breakout typically goes with the overall trend of the market, right? Which you would identify on the higher time frames. Okay, so just to sum it up, this is only one type of liquidity model, and we'll see a few more just after this lesson. But just to sum it up, right? Above and below the range, we have buy side liquidity and sell side liquidity, and essentially the sell side liquidity is the contract the buyer sells at a loss, which is met with a buyer on the other end, right? Which is this case here. And then the buy side liquidity, which is up here, right? It's the contract the seller buys at a loss, which is met with a seller on the other end.